Subsidiary is an independent cash generating unit, and we've got a set of data that has been given to us. And it's all about subsidiary X. Now the fair value of the parent's investment is 300, NCI is 80, net assets are 100, net assets at the year end are 150, and we can recover 200. The recoverable amount is the higher of the fair value less cost to sell and the value in use. If we're going to do an impairment review, the first thing we will need to do is calculate goodwill. Calculate the impairment loss from the impairment review of X on the basis that NCI is at fair value. So if NCI is at fair value, goodwill will be in full and any impairment loss will be split. Will be split between the parent and the NCI. So if I'm calculating goodwill, I take the fair value of the parent's investment, which is given to me at 300, the so-called controlling interest. I then take the NCI, which I'm measuring at fair value based on the subsidiary share price, and the NCI is 80. I then take the fair value of the net assets at the date of acquisition, which is said to be 100. So I have got here a business which in aggregate is worth 380, but the assets are only worth 100, so the goodwill as a result is 280. When NCI is at fair value, goodwill will be in full. When NCI is at fair value, goodwill will be in full. We're about to do an impairment loss, so I assume there will be an impairment loss, and the impairment loss will be split. So whatever impairment loss we get, 80% of that would be a negative, so far as retained earnings were concerned in working 5, and 20% of that would be charged to the NCI in working 4. This would then give me my year-end figure that will be going on the balance sheet. My challenge is to work out this number. So an asset is impaired when the carrying value exceeds the recoverable amount. This is not an asset, it's a CGU. And the CGU is made up of both the net assets and the goodwill. So we've got an impairment review to be conducting. Now when we do the impairment review, the carrying value is our CGU and is our subsidiary. So we have our year-end net assets, and our year-end net assets are 150, and we have our goodwill, which is our full goodwill, which is 280. This means that the carrying value is 430. You can't test goodwill on its own. You can't sell it, nor on its own does it generate any revenue. So your carrying value is 430. If this exceeds the recoverable amount, there will be how much is the recoverable amount? 200. So there is an impairment loss. If the recoverable amount was 600, you've done the test and there's no loss. But the recoverable amount is less. So the impairment loss is 230. For the avoidance of any doubt, that 230 relates to that 280. That's what you will then allocate the loss to. Now we're going to split that impairment loss, yeah? So we're going to take 230 away from there, and that's going to give you a year-end goodwill of 50. 80% of that 230 reduces your retained earnings. 20% of that 230 reduces your NCI. as a recap, you're reducing your retained earnings by 80% of the 230. You are reducing your NCI by 20% of the 230. And you are reducing your goodwill by the 230. And those of you who love your debits and credits understand exactly what is going on there. But whatever you take away from the top, goodwill is coming down by 230 at the top. That's the same amount that you take away from the bottom. So what you credit against the goodwill, you debit against the equity, splitting it between my share and the NCI share. So, you know, there's lots of different ways of explaining it, but what you've got to do is process in your retained earnings calculation 184 and process in your NCI calculation 46. And both of these are negatives. On your balance sheet, goodwill is 50. Now we're going to do the same again, or I'm going to do the same again, except this time in the context of Part B. And what is different about Part B is that NCI is a proportion of net assets. So goodwill is attributable to the parent. So the impairment loss is all to the parent. And there has to be a notional grossing up in the process of doing the impairment review. First things first, let's calculate what the goodwill is. The fair value of the parent's investment is the same at 300, but the NCI is a proportion of net assets. So this means we can do a small calculation that 20% of the net assets are attributable to the NCI, and then we have the fair value of the net asset. That's data acquisition of 100, and we have got 220. This gives me the goodwill attributable to the parent. And when there is an impairment loss, it will be attributable all to the parent. Because if it's the parent's goodwill that's being written off, then the only person who should suffer is the parent. If it's the parent's goodwill that's being written off, the only person that should suffer should be the parent. So whatever that impairment loss happens to be, that will then give you your year-end figure. When we calculated NCI at fair value, the NCI at fair value was 80, and that gave us a bigger figure for goodwill. When we have the NCI only being 20, we get a smaller figure for goodwill. That's what I expect, that the goodwill is attributable to the parent company only. Most of you I've taught before, some of you I haven't taught. What I'm about to say, I don't know. Doesn't really matter. when I say goodwill is attributable to the parent company, when I say NCI is a proportion of net assets, goodwill is attributable to the parent company only, I really mean it. And on one level, you can just trust me. On another level, though, you might be able to understand it. Although I can't see there's a difference in the exam. But this is just going to take 30 seconds. The parent pays 300. I am the parent. I pay 300. And that buys me 80% of the business. What we're then doing is taking away 100, but adding 20. We're taking away 100, but we're adding 20% of 100. The net effect of what we're doing is we are comparing my investment, I am the parent, with my share of the net assets. So we're going to get my share of the goodwill. The goodwill that we get here is really only 80% of the total goodwill, because you've only put in 80% and 80%, so you only get out 80%. Now, if that rings your bell, fantastic. If it doesn't ring your bell, let it go. But just please, all of you, remember that when NCI is a proportion of net assets, goodwill is attributable to the parent company only, because it has a knock-on effect with exchange differences and all sorts of funny little things. Anyway, here am I working out this impairment loss, and in order to work out this impairment loss, I need to do my impair. Yeah, so I'm moving on. Some of you are happy, some of you are, what's going on? So what have we got? We've got a second impairment review, and that impairment review has a carrying value, and in doing an impairment review of goodwill, you have to consider the CGU, and in this context, the CGU is the sub. So we have our year-end net assets. How much are our year-end net assets? Our year-end net assets are 150, and we want our full goodwill. We haven't got our full goodwill. The goodwill that we have is 220. Now this has to be notionally grossed up for the purposes of doing this. So this is notional, so it's notionally grossed up. It's notionally grossed up. And this is where my mental maths will not cope. So what does the goodwill become? 275. 275. So we get a figure of 275, which is therefore 3, which is therefore 425. Yeah, 425. This enables us to compare this to the recoverable amount. I mean, the reason we're having to do the grossing up, is because we want a consistency. That represents all of the assets. That represents all of the recoverable amount. So therefore, you actually want to have all of the goodwill. And if you bring in 220, 220 only represents 80% of the goodwill. So it's a rubbish number that you notionally have to gross up for the purposes of calculating the impairment loss. Now, the amount of the impairment loss, therefore, is, no, it's not 225. The answer isn't 225. Because this 225 relates to the 275, and the 275 is not me. I am only 220. So I only really want 80% of that 225. So your actual impairment loss, so that is your impairment loss, but that is including the notional grossing up. So your actual impairment loss is 80% of the 225. And 80% of the 225, what What have we got? How much is that? 180. And so that 180 is the real deal. This 180 is the real deal. This 180 is the number that relates to your real goodwill. And your real goodwill is 220. The goodwill in the question is 220. So I'm being entirely consistent when I then take off 180 against the 220 and say that at the year end your goodwill will be 40. To recap on that, if you want a recap on that, easy to give you a recap, a repetition. What have we just done there? We have reduced our retained earnings by 180, working 5, and we have reduced our goodwill by 180. None of this mamby-pamby splitting around malarkey. If it's my goodwill, I'll take the hit. If it's my goodwill, I will take the hit. Right. We need to put this together. So, let me just stand up here for a second. Let me just pause. Yeah? Is that okay? Go. Right, okay. Go. Right. Now, what happens in the exam is that we have two subsidiaries, and we have a lot of these adjustments flying around, fair value adjustments, disposals, control to control, impairment, there can be associates, there can be all sorts of things happening. But it's for sure that you will have to calculate goodwill. It's for sure you're going to have to work out the pre- and post-acquisition profits. What I'd like to do this afternoon is to have a look at a question, not a full-blown exam question. My intention is tomorrow morning we're going to have a look at a couple of full-blown exam questions. But what I'd like to do is to place some of these issues in context, and this is on page 29. Page 29.